Leverage is a financial concept that refers to the use of borrowed funds to increase the potential return on investment. It involves using debt or other financial instruments to amplify the potential gains or losses of an investment or business operation. Leverage can be employed by individuals, companies, or investors to enhance their purchasing power, expand operations, or speculate on financial markets. Here's a detailed explanation of leverage. When an entity, whether it's an individual, a company, or an investor, decides to use leverage, they borrow funds to increase their exposure to an asset or investment. This borrowed capital is used alongside their own funds to make investments or conduct business activities. By doing so, they can control a larger asset base or investment position than they would be able to with their own funds alone. Let's explore the types of leverage. First, we have financial leverage. This type of leverage involves borrowing funds to invest in financial assets such as stocks, bonds, or derivatives. By using borrowed money, investors can increase their potential returns if the value of the invested assets appreciates. However, it also magnifies losses if the value of the assets declines. Next, operating leverage. Operating leverage refers to the use of fixed costs, such as rent, salaries, and depreciation, to increase the potential profitability of a business. Companies with high operating leverage have a higher proportion of fixed costs relative to variable costs. This means that small changes in sales or revenue can lead to larger changes in profits. Lastly, real estate leverage. Real estate investors often use leverage by obtaining mortgages or loans to purchase properties. The income generated from the properties is used to cover the debt service, and any remaining income contributes to the investor's equity. Real estate leverage can amplify returns when property values appreciate, but also increases risk if property values decline. Let's delve into the benefits of leverage. Leverage allows investors to control a larger investment position with a smaller initial capital outlay. If the value of the investment increases, the returns generated on the leveraged portion of the investment can be higher than if the investor had used only their own funds. Additionally, leverage can enable investors to diversify their portfolios by spreading their capital across a broader range of investments or asset classes. This can help reduce overall risk by offsetting potential losses in one investment with gains in another. Now let's consider the risks of leverage. While leverage can amplify returns, it also magnifies losses. If the value of the leveraged investment decreases, the losses incurred by the investor will be larger compared to if they had invested solely with their own funds. Moreover, borrowing funds incurs interest costs, which must be paid regardless of the performance of the investment. If the returns generated by the investment are lower than the cost of borrowing, the investor may experience a net loss. Additionally, in financial markets, investors who use leverage to trade on margin may be subject to margin calls if the value of their investment falls below a certain threshold. This can result in forced liquidation of assets at unfavorable prices, further exacerbating losses. Moving on to risk management. Proper risk management is essential when employing leverage to mitigate potential losses. This includes maintaining adequate liquidity to cover debt obligations, diversifying investments to spread risk, and setting stop-loss orders to limit potential losses. Overall, leverage can be a powerful tool for enhancing returns and expanding opportunities, but it also carries significant risks that must be carefully managed and understood by those who employ it.